to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio and our guest Adam Grimes. But before we get started, quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. Risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. So with that out of the way, let me jump over to your presentation and see if I can give you control. Let's see,
okay.
There we go. Now let me start the presentation first. And then I think I can pass keyboard and mouse control. There we go. Haven't done this for a while, so hopefully it works.
Okay, looks like I have it. Okay.
Good.
Let's make sure. Good. Okay, we're good. So, Tom and Jim, thank you for the opportunity to come and speak to your group today. I do quite a bit of speaking, and some of you may have seen my blog or read some of the things that I've written in different places. And, I'm pretty easy to find on the web. I'll give you contact information at the end of this presentation. But in general, I really value feedback and interaction with readers and listeners. So, as we go along today, if you have questions, put them in the chat box. And, I may, if I don't get to the question right away, I certainly will get to it at the end. It's just whether it might be more appropriate to do it there depending on the flow. But if you have a question, go ahead and put it in at any time. Let me give you kind of a high-level perspective of what we're going to do today, and I'll tell you a little bit about where I'm coming from. So I'm going to talk to Tom and I discussed, what would be most interesting to this group. What would you like to hear about? And one of the concepts that really fascinates me is the idea of randomness in markets and randomness in trading results. And, there are this is one of the enemies, in a way, of successful trading because it makes everything we do so much difficult. It's also, though, we won't get too much into this, but it's interesting on a philosophical level when you think about the very foundations of the discipline of statistics and how everything we understand, we only really understand in this kind of massive cloud of probability. So we get into some kind of interesting epistemological issues, but we'll probably won't veer too far into that today. So what we're going to do, I'm going to talk to you a little bit about a way to think about market prices that is really centered about data and evidence and proof as far as we're able to have it. We will spend quite a bit of time talking about randomness, what it is, what it does, how we can guard against it in some ways. And then I don't want this to be an hour of me spouting hopefully interesting but mostly useless philosophical stuff. I also will tie this in at the end with some useful market patterns. And we'll take a look at current market conditions in stock index futures and in crude oil from a directional perspective. And of course, however you choose to implement that through options or futures or spread, in any number of ways that you can trade these tendencies. My focus is on directional trades, and we'll wrap this up so you see how this all works together. So thinking about understanding markets, some of the things that make this so very difficult, and those of you who have been trading for a while, actually most people who've been trading for any time at all, we pretty quickly discovered that this is a hard game. This is much harder to make money in the market than we might expect. Why? Well, I think a lot of the reason it's so difficult has to do with who and what we are as humans. And one of the things we begin to realize is that human perception is fundamentally flawed. We're good at certain things. We're very good at certain things. We're very good, for instance, at recognizing faces. We're very good with language. And this means we're very good with finding patterns. This is why you can look at wood grain or look at clouds and you'll see faces, you'll see patterns. But the problem is, of course, we find patterns even where there are not patterns. And I think a lot of what is written and said about financial markets is because of this. people don't understand, particularly some of the older work that many people hold in such great respect. And some of that work certainly is valuable, but a lot of it, I think, does not fully respect the problems we have with perception or how random markets can be. Um, as far as understanding randomness, we're really bad at it. The things that we do well as humans, uh, great big pile. And one of the things that we do so poorly is even to understand what might be and what might not be random. I'll show you some examples in a little bit. We're also not very good at judging relative importance of events. And, many of us have trading results where we put too much attention on big winners, big losers, recent winners, recent losers. So there are all these reasons that we have trouble really understanding the importance of things. Another challenge here, and this may surprise some of you who, it seems like we're buried in market data, but there really is not, compared to other disciplines, there really is not that much market data. There are only a finite number of instruments that trade, and even looking at certainly looking at daily bars, we have a few thousand, tens of thousands of data points. In other disciplines, we might be looking at hundreds of thousands, millions of data points. So there really is not that much financial data in some sense, and it makes it a little bit difficult to apply these tools of statistics and probability. Also, correlation, by the way, if you trade stocks, there really are not. How many listed stocks are there? 7,000, 8,000. Of course, most of those don't trade. Maybe there's about 1,000 liquid stocks. You don't have a sample size of 1,000 because they're so tightly correlated. Stocks, everything moves with the market to a very great extent. So that's a problem. And then we'll talk about randomness here too. Thinking about patterns and prices. So I won't read this chart to you, but there is a spectrum. There's a range of people who, on one side, you have at the bottom of the slide, you have academic researchers, many of whom look at prices and say there are basically no patterns here. There's nothing we can see that is significantly different from random walks. Most of the options pricing models, as you know, make some type of random price movement assumption in some way. And then all the way over on the other side, we have a fringe that says prices and patterns in prices somehow reflect the, fill in whatever mystical concept you want, sacred geometry, secret foundations, whatever, that there's some great, the same force that shapes the wind blowing in a circle outside my window right now, traffic patterns, also shapes market prices, and if we can understand that, then basically we can understand everything about markets. Then there are people in the middle. And what I won't spend too much time on my development, but I will tell you that I started out very much believing that things could be explained, that there was some secret code that could be cracked. And through about, I've been doing this for 2 decades now, give or take, and a lot of quantitative research, I began to realize that that's not true. So much of what we see is just random garbage and unexplainable. So what I want to talk about a little bit now is kind of a framework for thinking about market prices, a framework for understanding market movements. And if we think about what moves prices, well, it's very simple. There's no mystery. People buying, people selling, people being willing to buy and sell, that's all that moves prices. There is nothing magical about this. There's nothing mysterious about this. Sometimes we can't see the buying and selling pressure in the book. Depends on the microstructure of the market, how the market is set up. Sometimes it's very clear, but it's still people making decisions to buy and sell. So then take that chain one link further and say, why do people buy and sell? Now, this is important. So far, this is probably the most important thing I've said. People make decisions to buy and sell based on rational analysis and also on emotion. And that's one of the big departures from a lot of the academic theories is we need to understand and acknowledge how important emotion and behavioral aspects are, because everything we do as humans incorporates an element of both rational analysis and emotion. And this idea that we're going to eliminate emotions, I think that's a very wrong-headed way to think about any decision, because you are not going to eliminate emotions. What you can do is incorporate them into your process in a way you understand. But everybody out in the market making decisions, moving prices, is using both reason and emotion. And if you're thinking right away, well, what about the algorithms? What about the computer programs? I would argue still that there is an element of emotion in those, even though the algorithm running is dispassionate silicon brain making decisions based on pure rules. There's still a human that said, I'm going to execute the system. There's a human that developed the system, and there's a human that determined how much capital to allocate to the system, and there's a human who someday will decide to turn the system off, much, sometimes much to the detriment of markets. So there is definitely, in even the heavy-duty algorithmic trading, there's an element of emotion. And because of all this, we don't need any mysterious explanations. And I'll come back to this. I'm going to talk about Fibonacci. I want to challenge your thinking in some ways today. That's one thing that I really hope to accomplish, is to give you a new way to think about. And you may disagree with basically everything I say, and that's fine. But I would at least like you to go back and reconsider, reevaluate some of your assumptions, and maybe have a richer understanding of what you believe and why you believe it. So let's start here. We won't spend a lot of time here, but most of you probably know the efficient markets hypothesis, which is the idea from academic research that basically says it's not possible to make excess returns in markets. In other words, you can't make money reliably over a large sample size trading above the baseline drift, so you should just index. You should buy an index fund, basically. And there are a lot of variations to this. We don't really need to go into this. But if this is true, and this idea, I think too many times traders just say, oh, that's garbage, it's ridiculous, it doesn't reflect the real world. If that's true, then it would be bad news for traders. Yeah, I mean, it's one reason why people don't want to think about it. But it is an idea that a lot of very intelligent researchers who've spent their lives looking at data have come to this conclusion. And that it deserves some respect, it deserves some attention. And I'll trust your literacy here. I don't need to read the slide to you. But basically, the idea is that if markets are efficient, then any information that is out there is incorporated in the price. And if it's correctly incorporated in the price. And if that is true, since all that moves prices is information coming into the market, then we can't really make money because all the information is already incorporated. That's the argument of the efficient market. And a lot of the challenges that people throw up against the efficient markets hypothesis, these are some kind of, I don't mean to use this word in a bad sense, but I guess I'm about to. These are very amateurish challenges. None of these are legitimate challenges, but you can read many blogs, books, you can hear people talk about, distributions are non-normal, so price movements can't be random. Most of you with some mathematical background know that what I just said is absolutely ridiculous. Of course, distributions could be any particular distribution and still be random. This idea of baseline drift, stocks go up, give or take 7% a year on the long haul. Around that baseline drift, price action, price movements could certainly be random. Also, these isolated examples of super traders. I use an example in my book that if you put 10,000 people in a room, have them flip coins, everybody that flips tails, goodbye, keep everybody that flips heads. And repeat this over and over and over, keeping everybody that flips heads. And, at some point, starting with a large group of people, you will end up with a number of people who very likely have flipped an extraordinary number of heads in a row. And are these talented coin flippers? Well, of course, to answer that, we can see what happens next, right? Did these people have some specific talent to make the coin come up heads, or did we just get lucky? And the evidence, I have to be careful how I say this because it is sobering, but the evidence from looking at a large number of people trading is not clear. It's not particularly clear that there are super talented traders that we can reliably separate from luck, from random luck. So these are things that people talk about that we don't really need to spend a lot of time on. But here are some of the things. Now, why is this important? Well, efficient market hypothesis is this big, scary thing. And if we understand what the appropriate challenges to the theory are, then we might have some ideas where the treasure is buried. That's what this is all about, right? I'm not just spouting academic theories. If we understand where the theories might be flawed, then we might have some idea how to create trading strategies to capitalize on some of these. So credible challenges. Well, efficient market hypothesis makes some great assumptions, like we live in a world where there are no frictions, there are no taxes, no transaction costs. Can we go there? I think we would all like to go there, right? The big one is that everybody always acts rationally and never makes mistakes. And the evidence suggests that's not true in the real world. Traders do not act rationally, and they do make mistakes. And at times, at certain points, they do make mistakes reliably. So hold on to that idea. So we're going to come back to that. And that is one way that we might be able to capitalize on some of the movements of the market. There are certainly overreactions, underreactions to news. Those of you who watch the tape intraday sometimes see some ridiculous moves in stocks that are reversed 10 minutes later. Inside information, the fact that people pay for information suggests that information has value. Efficient market hypothesis were not true. The efficient market hypothesis were true, then there'd be no point in paying for information and nobody would do it. And by the way, if that happened, you kind of can think yourself in a circle, then nobody would have the information and markets would probably not be efficient. So it's maybe a chicken and egg. There are also, one of the very interesting things, and this is relevant, I think, to crude oil currently, is this idea that markets do go through long-term mispricings, that we have this boom and bust. And by the way, I see some comments that there are some background audio noise. I'm sitting in a quiet room with a broadcast mic, but is there anything I can do to make the sound better? Is it on my end or is it somewhere else in the system?
Mine was muted, so I don't think it was me. It was,
I was muted also.
Yeah, I saw you guys muted. I don't hear it, but
it could be your microphone, Adam. I'm not sure.
What do you hear? This is a broadcast microphone I use a lot, but what does it sound like?
It sounds like scraping the microphone against some clothing or something.
Very, very bizarre.
Adam, by the way, that's a great chart. I've always wanted to get one because I know who you're going to talk about, and I was never able to end up finding the price chart on that.
Yeah, I focus on. I kind of like a lot of these old prices. I actually have price charts going back through grain prices in Europe in the 1400s, and even I've done some quantitative work on price changes in antiquity. We have prices from commodities like dates and barley that were traded in Babylon. A lot of those, some of those very early tablets are, the clay tablets are price records. And so, yeah, I really like the old prices. Would you like me, I'm on my microphone, but would you like me to try to call in on the phone line? Do you think that might be better?
Yeah, the phone might actually work better if you want to give that a shot.
And while you do that, if it's okay with you, as you dial, I'll actually end up saying the quote. I can calculate the movement of the stars, but not the madness of man. Anybody know who said that? Sir Isaac Newton said it. He said it because he ended up investing in the South Sea Company, and he made a bunch of money in it. And he got out because he thought that it was as high as it would possibly go, and his friends didn't. Feeling that, he had missed the boat and he didn't understand the markets, he ended up rushing back in only to end up catching the top and then seeing it go down. I don't know about you, but boy, that we saw a lot of that happen during the .com boom and in other booms. So it's the randomness that you kind of figure if Isaac Newton couldn't figure this thing out mathematically, how do more mortals like us have a chance? So it is a challenge. So I'll be very interested to see, Adam's take on this once he dials back in.
Okay, I am back in. How's the audio? Is that better?
Yes.
Okay. Oddly enough, on my end now, it sounds it sounds very bad, but if it's better for you, that's what really matters. So do you want me to pick back up, or it sounds like I missed a little bit of discussion? Was something you wanted me to dig into?
No. All I did was I ended up giving him the Sir Isaac Newton quote.
Okay, good. So I will actually. Okay, good. So going ahead here. So some other credible challenges. One is that idea that crowds do get kind of crazy and that emotions get very extreme, and that it's very hard to quantify the limits of what people will do. Some other things are maybe a little bit more quantitative, autocorrelation in returns. And basically what this means is, the standard random walk is usually some variation of, a good way to illustrate it is to imagine a very drunk person who will take a step to the left or right and step forward to the left or right, and each step he has no memory of the past step and is completely random. Autocorrelated returns could indicate trending markets because what this suggests is that if a market has been going up, it is more likely to go up in the future. That's not technically mathematically correct, but conceptually it's accurate. The other thing that is very interesting is volatility clustering. And this is important for everybody, particularly important for options traders. And the idea here, what you have, the kind of interesting chart in the middle is, I believe that's the S&P 500, just showing each day's move as a standard deviation of the past 20 trading days, and I believe this chart erases everything under 2 standard deviations. So what this chart shows is over the space of 2.5 years, give or take, shows just the big. These are probably absolute moves too. I'm sorry, I don't remember exactly what this chart is. So it's the absolute value of the standard of each day's return as a standard deviation of the past 20 trading days, and just focusing on the greater or less than 2 standard deviation moves. So what this shows is that when a market has a volatile shock, that your best bet for the immediate future is more volatility. So then there are other ways to model this, but that's an important understanding, and that can shape. People vary in how quantitative they want to get, how mathematically they want to think about the market. But at least you need to know if a market has some volatile move, then that market is more likely to be volatile in the near future than it is to be quiet. And we'll come back to the last point there, patterns and prices. So this is how I think of all of these questions of efficient markets and how this applies to actual trading. And this is kind of my core understanding where I'm coming from with markets. So I assume that markets are almost always, but not always, efficient. And what this means is that in most markets, at most times, there's no opportunity for profit. In most markets, at most times, that the price movement is going to be random. There's nothing I can do that will allow me to pull money out of that market if it is random, and usually I have no business being involved. That's very important. It is also true, in my experience, that these inefficiencies, which is just kind of an academic way to say spots we might be able to make money, these inefficiencies come in spurts. Perhaps that is somewhat related to what I showed you on the previous slide with the volatility clustering, but typically when we have some point where a market is overextended, where traders have made mistakes perhaps, where there's something extreme happening, we'll have some more things in the future. And this is why, maybe one reason why most trading systems experience runs of wins and losses. Also, I think, and this is a little bit more theoretical, but market efficiency may be an evolving process. One thing this tells us is that today's trading system might not work tomorrow, and there needs to be a certain amount of ongoing development and quite a lot of ongoing monitoring to make sure that what you're doing continues to work. So bottom line, price movements are mostly random. It's really hard to make money in the market, but there are some patterns in prices, and we need to spend a lot of time thinking about the behavioral factors. So randomness. I'm going to go through this a little bit more quickly, some of this, but the idea is the reason why all this matters is if something is random, you can't make money with it. Now, it's not to say that you won't make money. You won't have some winning trades. If we play a game a very boring game where we flip a coin, comes up heads, I pay you $1, comes up tails, you pay me $1, and we play that game over and over and over, there are going to be times where each of us makes some significant money, and we'll talk about why in a moment. So it's not like you're never going to make money, but what you are not going to do is make consistent money. What you're not going to do is make money with any degree of reliability, and what you're probably, from a very practical standpoint, not going to do is you're not going to be a professional trader. You're not going to be able, if something is random, the market is random, or your system is random, you're not going to be able to make money with it. And this is kind of an interesting slide. So this goes to the point of us being very bad at understanding the randomness. I'll tell you this happens on two levels. So the first thing I would like you to do, look at group 1 and look at group 2. And these are heads and tails strings of coin flips. And the graphs down at the bottom, little boxes, just take the same information in letters. Some people like to see the boxes. Some people would rather see the letters. Take a moment and look at those and think which group is random. One group is truly random. I sat down and flipped a coin. The other one was actually created by a professional statistician with the idea, somebody perfectly aware of the human foibles and the human tendency to make certain mistakes around randomness, and this person tried to create a random series. So now that you've looked at that, I will tell you that one of the ways we can test for randomness is we would expect in 10, in each group there are 10 coin flips, I think. Is that right? I hope so. Yes. So there are 3 groups of 10 coin flips. We would expect to see roughly 5 heads in each group. And another thing that we might look at is to see how many times heads or tails appear in a row. And this is called a runs test. And what I've done here is highlighted with boxes the runs, consecutive heads and consecutive tails. And you can look at this. I'll flip back and forth between the two slides just for a moment. So you can kind of look at this and think about it in this context. And which group do you think is random? Well, the truth is that this group 1 is truly random. And I forgot. I actually, in this slide, I did not use the example of me sitting down and flipping coins. I used an even better random noise generator, but whatever. Group 1 is truly, honest to goodness, as random as it could possibly be, and group 2 was created by a human. The punchline here is that random data, and this goes directly to our trading results. Random data has far more runs in it than we would expect. You will have far more consecutive winners and losers in a random distribution than feels right. And this is a problem behaviorally because how do you know what you're doing works? Well, we have some element of human intuition and human feeling about it, and you can't trust that because you don't. Not just you, but like big picture humanity, we don't have very good perception of randomness. That's kind of the point of that example. I'm going to flip ahead here a little bit. You've all seen this. These price charts are randomly generated. The fact that we see most of the patterns that we see in the market in random data just as often does not necessarily mean a lot, but it should give us more respect for randomness. This is what I did today, and I'll give you these slides so you can spend some time with these slides, but I pared down a much larger presentation to try to squeeze it into an hour, so that's why I'm glossing over some of this stuff. I decided to leave the slides in, so when you have the slides, you can go back and spend some time with them and think about them, and also, certainly open to follow-up questions. So, this just kind of recaps that point earlier. A lot of developmental people who think about human development think that maybe one reason we are so bad at understanding randomness is because there would have been really no evolutionary payoff. If you think about some of those things I listed at the beginning that we're good at, language, recognizing faces. If you can imagine very, very early humans who had those skills, probably did better in society and were probably more likely to survive. If you could imagine a human who was was really into figuring out, so this grass is moving, and there seems to be a shadow in there. What's the probability that that's a tiger about to eat me? Does that person survive, or does the person who sees shadow move run and has the reaction immediately? It's very possible that many, many thousands, millions of years of evolution have selected us to not be very good at dealing with randomness, and so some of the patterns that we find exist for other reasons. So I want to show you an example here, and again, you can look at this slide. I want to show you a flip to the next slide, which are the results. This should be very sobering. And what this shows is the results of a system. So on this slide, there are 100 traders who trade 250 trades from a system that does have an edge. And the expected value of the system, you started with $100,000 capital on the left, and the expected value of the system is that you should have ended the blue arrow on the right with $150,000. That's the expected value of the system. Now, we talk about sample sizes, and everybody says you have to accumulate enough trades, law of large numbers, convergence, blah, blah, blah. Well, what's that number? The number that's thrown around many times is 30. People want a sample of 30 trades. Okay, well, here's 250 trades. Have we converged? That's the question you should be asking. And I want you to think for a moment about this chart. So each line is, you can imagine, as a separate trader. However you want to think this, parallel universe or whatever. None of these traders made mistakes. Nobody held on to a loser too long. Nobody over-leveraged a trade. There were no mistakes. These are all drawn from the same distribution, the same system, and you had, in this system that had a positive expectancy, look particularly at the beginning how many traders were underwater for 100, 150 trades. And you did have a trader who lost a significant amount of money trading a positive expectancy system. And you also had a number of people who did much, much better than the expected value. And this to me is sobering because, and you can think about this a lot of different ways. This is just an example. But even when we do heavy-duty statistical analysis of our own results, there's still that random component. And, this poor guy who lost quite a bit of money trading the system did everything right. How did he feel about that? What was his subjective experience of trading this positive expectancy system? And it also, at the same time that it makes us question what we can really know, to me it also tempers the emotional component, or it can and it should. If you understand that a lot of what you're experiencing is out of your control, then you can focus on those things that you can control and not worry so much about the things that are outside of your control, and realize that a lot of the emotional reactions we have to our trading performance are inappropriate, just not justified. One of the things that makes trading so hard to learn is the aspect of reinforcement. And if you think about training an animal, teaching a dog to do something. We talk about reinforcement schedules. So when the animal, or in this case the trader, does the right thing, the trader gets a reward. And there are several ways that this can work. If you're teaching the dog to sit and you do continuous reinforcement, which is every time the dog sits, you give the dog a treat. You give the dog a reward. Well, the problem with this seems like this would be the best way to train, right? The problem with this is that in continuous reinforcement, as soon as you stop giving the dog a treat, the behavior will stop. And continuous reinforcement, which seems like it should be so powerful, is actually not a good way to modify behavior. What is a good way to modify behavior is some type of random reinforcement schedule. So you tell the dog to sit, the dog sits, you pat his head or you do nothing. Tell the dog to sit, you give him nothing. Tell him to sit, you give him a treat. So the dog never, this is a way, and we see this in many, many animal behavior studies, that random reinforcement is a great way to make behavior permanent. And this is what the market does to us. This is one of the real challenges of trading. The market is so random. You can do something very, very stupid and make a lot of money. You can do the right thing over and over and over and lose money. Think back to that chart earlier where everybody was doing the right thing. Some people lost quite a lot of money. Even over a reasonable sample size, there's a huge spread in results. So the problem with this is if we tie too much attention, if we put too much attention and tie too much of our sense of self-worth as traders to any specific trade result or any string of trade results, then that may be very counterproductive. A trade is just a trade. And I think you have to work very quickly toward that mindset where a trade is just a trade. We also have to understand that, and I said this earlier on, randomness is really the enemy. And when we think about this, when we think about the amount of random fluctuation that is in the market and is in our trading results, this really obscures whatever reality there might be. Statistics, quantitative measurements, there are a lot of things that we can use to cut through that. I'm going to show you some examples of that. But the interesting thing is no matter what we do, whatever we think we know, we only know within the realm of probability. And this works, whenever I talk about markets or write about markets, I'm very careful in what I say. I try to be. You can't be the type of person, if you have a respect for the randomness in the market, you can't be the type of person who there's useful stuff coming up. But I mean, this is reality. And whether this is depressing or not, this is the reality of the market. So many people will show you the whatever system and say just trade this and you'll make money. It's a lot harder than that. And I think because people don't have a respect for this, and because people, when they think about difficult concepts like this, they just want to move on to being shown where to buy when the moving average crosses. This is one reason why the failure rate for traders is so high. Now, your next question is, but doable? Yes, absolutely doable. The failure rate for traders is high. It's certainly not 100%. Some people do. Some people do succeed, and it is possible to make money in the market. I'm going to show you some ways to do that. So I want to actually, with that, I will leave you with these slides, but let me skip ahead to show you some of the things. Okay, so I've done a lot of writing and a lot of talking about quantitative methodologies and how to analyze tools that work and tools that don't work. And basically, I think one of the things that is a little bit different with my perspective in markets is I demand proof. And I did not start there. I read every book on technical analysis, looked at every tool, believed everything that I was taught, and it was only after I really started crunching a lot of numbers and saw the trade results of thousands of trades that I began to develop a very cynical mindset. And my fundamental assumption is, because I know how difficult it is to make markets, because I have respect for how random markets are, that most tools don't work. And the burden of proof is on the tool. I need to be able to pull out statistical evidence that shows that the tool has some edge, says something about the market. And what I'm looking for here is basically, imagine something that doesn't have an edge clearly, flipping a coin. Let's say every time I decide to buy and sell a market, I flip a coin. It's a completely random thing. It has nothing to do with the market. And what we would see if we looked at trade results after I flipped those coins and made my decision to buy or sell, that the results looked completely random. That's over a large sample size. What I assume is that any trading tool that has value is going to look different than that coin flip. It's going to show me that after this condition occurs, and we'll talk about what some of those conditions are, then the market is more likely to go up, more likely to go down. Perhaps we can also talk about volatility. Is more likely to be more or less volatile. And if I don't see that, if I can't see that in a statistical test, then I'm not interested in using the tool. And I've spent many, many, many hours and days and weeks, months of my life doing this type of testing, and I realize here what I have on test results, this is not terribly compelling because I did not just spend a few hours explaining the methodology and leading you through the thought process. A lot of this is on my blog, by the way. You can go to my blog and find some of these tests in considerable detail. But things that I have found that do have an edge are some very simple price patterns. And we need to understand that the edge is not 80%. The edge is not 90%. The edge is more like 55%. There is a 55% chance that this is going to happen compared to a 45% chance the other thing is going to happen. And if we understand that, then we enter every trade with an appropriate degree of humility, and an appropriate focus on risk management, because we know even though I'm doing the right thing with the right statistical tilt, there's still a pretty good chance my trade's going to be wrong, so I've got to limit my risk on that trade. Other things that work, mean reversion tools, looking for places where a market is stretched to an extreme and is ready to snap back. And there are a number of ways we can structure this. These tools do have an edge. Momentum. And there are many different ways. So, talk a little bit more about these. But mean reversion basically is the tendency for a market to snap back. Momentum is the counterbalancing tendency for a market to make a big move and then to continue to make a move in that direction. Momentum tools, well, there are patterns, pullbacks, breakouts, or momentum patterns. Relative strength is a momentum pattern on a larger scale. So with relative strength, what we're looking for are groups of markets, currencies, stocks, futures that have moved with more strength than others, and those are more likely under some conditions to continue to be strong in the future, vice versa to the short side. There are some indicators that are based around these tendencies that do test out very well in statistical tests. I've given a few here: RSI, Keltner channels, Bollinger Bands. This is not at all an exhaustive list, so don't assume because something is not on this list that I'm saying it doesn't work, but these are things that have shown pretty clearly a statistical edge in my work. Now, here's where we get to more difficult things. Here's where people have some difficulty with things that I say. Things that I have not been able to find an edge, which is not the same, by the way, as saying the tool is useless. And this is a little bit, again, you have to understand the mindset is that I'm demanding proof. And however, if I look at, let's take an example, moving average crosses. If I look at hundreds of different combinations of moving average crosses in hundreds of different markets on many different time frames, and if I'm not able to find that with whatever moving average crossing that price movement in the future looks any different than I would have been able to predict with that coin flip, then that's not a tool that I'm particularly interested in using. And that's the case with moving averages. One of the people talk about, say, the 50 and the 200-day moving average providing support. Well, that's something we can test very easily. And, again, I'm not going to bury you in the tests here. Much of the work's on my blog. But if you can imagine a 50-day moving average under a market, and I look at every time price comes down to touch that moving average, and then look what happens in the future, that movement should look different than just, let's say the coin flip entry. That's the thought process. And, there's also this idea that some moving averages are special. 50, 100, 200-day are commonly thrown out, that those people watch those so they work. People talk about the self-fulfilling prophecy of technical analysis, which, by the way, I never understood that. I don't really have a problem with that. But, people say, oh, technical analysis just works because it's a self-fulfilling prophecy. I don't care. It's the fulfilling part that's fine. If we had something that worked just because everybody did it, but it worked, that is fine. The problem that I have with a lot of the traditional tools that people use is that they don't work. They don't work beyond a coin flip. You can put anything on your chart that's meaningless and it's not going to help you or hurt you. I only want things that I can prove that help me. Same with Fibonacci ratios, and I actually will. I know this is a topic that is near and dear to many people's hearts, and people get very passionate in this discussion, so I'm going to show you a little bit more of my tests there. Sentiment is very, very tightly correlated to market movements. There are very, very few cases where you can find price extremes that are not accompanied by sentiment extremes. So what you can do is go back any point in history where markets made a big reversal, there was a sentiment extreme, so therefore you can say market reversed from a sentiment extreme. Of course it did, but is that necessarily predictive? I've not been able to prove that. And the same with most chart patterns. Now, I do have some caveats here. I do have some questions. Let me see if I can hit these. So pivot points. Pivot points are an important structural thing. Pivot points, I do use some pivot points in some sense in my work. It's a little bit difficult, and you'll see on the next slide, one of the problems with testing this stuff is you have to be able to quantify it. So, to answer, do pivot points have an edge? It depends how you're using them. Mean reversion of volatility, how it may be used, Andrew asked, have I looked at the mean reversion of volatility and how it might be used to generate a trading edge? Yes, that's something I actually focus as much on volatility and what the limits of what we can predict in volatility as I do on direction. And he is correct. There definitely is there are things that you can do with volatility, and there are things you can do with volatility that actually go back to targeting direction. For instance, a pretty good trading system, it's not difficult to develop a trading system based on the VIX where you're trading the S&P. And the concept is every time the VIX spikes, you buy the S&P. So every time Twitter is freaking out and the media is freaking out about the end of the world because the VIX has popped, you're going in to buy stocks. A system like that, and of course, that's just a very broad concept. You have to do some work on it, but that concept does work. Have I looked at the squeeze tool, combination of Keltner channel, Bollinger momentum indicator? That's not something that I have tested. If you want to send me an email and if I can fit it into my schedule, I'll take a look at it. I have done extensive testing on both Keltner channels and Bollinger Bands, and there's a similar edge to both. Frankly, they're visually they're pretty different. Quantitatively, they're pretty much the same in what they do, and there is an edge to both. Dennis is asking about Python. Let me hold that question for later. If I happen to forget that, please remind me, and we'll talk about what to do with Python and how you might get started with that. So let me, now that I've just kind of shot a lot of holes in things, some things that we need to be aware of. There definitely are things that we can't quantify, and it's important to, with all of this work, it's important to be humble. And once we start crunching numbers and start getting, kind of scientific, it's very easy to think, I have answers. You don't. You have specific answers that apply to your specific data set with your specific methodology, and hopefully you didn't make a mistake. So hopefully we have good answers, but they're still very limited answers. And there may be things, there may be traders that can trade and find edges and things that we just can't capture in a system test. It's also possible, I won't read the rest of this slide, but we just need to be aware that there's definitely a limit to what we can do. And just because I'm showing you something I have not found an edge in doesn't necessarily mean that it's garbage. Fibonacci ratios, I think most of you probably understand Fibonacci ratios, and the idea is, here's the way that I tested them. So I created a system to identify swings, and you'll have these slides. You can go back and look at the slides I just blew through. But it's a system that actually is based on pivot points, but it also requires the market makes a certain distance movement away from the pivot to trigger a flip of the pivot structure, of the swing structure. And you can run this with different parameters, and I did. I'm showing you one example here. But the idea here is what we all think is that market makes a strong move, and then these Fibonacci ratios, and I'm showing you very good examples here in Apple of Fibonacci ratios that worked almost to the tick. And we can find many, many examples of these where the retracements stop at or near the Fibonacci ratios. Interesting, one of the questions I had about Fibonacci work when I started doing research is why do so many traders use 50%? When 50% is not a Fibonacci ratio. But in everybody's list of Fibonacci ratios, 50% is there. Why? Hold that thought. We will come back to that. I think there's a reason. So then what we can do is measure the swings. And this chart's a little bit difficult to explain, but the idea is that we measure each retracement as a percentage of the previous extension. And this is difficult to read because this goes both directions. I have, in the interest of time, I'm going to skip over this. It's in my book. It's on my blog. And if it's not, then let me know, and I will make sure that it is. But what I have done, I'm going to skip to the distributions. If Fibonacci ratios worked in the market, what we should be able to do is go back and look at hundreds of thousands of swings, and I would assume find some distribution that looks something like this. So, what I've done here, imagine that each of these is a swing as a percentage of the setup swing. And if Fibonacci ratios are, quote, real, we should see more of the retracements kind of cluster somewhere around, Fibonacci numbers, 38, 62%. Maybe not a nice bimodal distribution like we have here, but there should be some evidence of it. What we actually see is this. This is based on many, I don't even know how many swings. And I also did this, if you're asking questions, did you try this parameter? Did you look at this? Did you look at this? I looked at this in so many ways, and the results were remarkably consistent. And the punchline is, and I'm going to fast forward a little bit. Look, and you have these slides again. You can look. I break it up by asset class, break it up looking at only the best trades, the trades that would have given you enough profit area. What we really see, and I suspect the reason that people focus on 50% is because that's kind of the number that works. And that's how I think of retracements, that they tend to end around 50% with a huge margin of error. So they may end 20%, they may end 80%. A lot of them are going to end around 50%. Now, you might say, wait, that's not so different than a Fibonacci number. Well, but the problem is when people start expecting the kind of precision from Fibonacci numbers, expecting them to mean something, and they're just actually random fluctuations in the market. Why would you ever put a stop beyond a Fibonacci number? It's illogical. It doesn't make sense. It only makes sense if swings tended to terminate there. And because we find examples on charts, that does not prove anything, except that we find patterns on charts very easily. So, again, you'll have these slides. You can take some time and look at it. But I'm very critical of this tool because I have not found any utility in it. And the kind of interesting thing is that it's not so much of a negative thing as that you don't need it. That's the punchline. Sometimes when I talk about these things, people are like, well, if you can't figure out how to make money without Fibonacci ratios, well, people say, well, if you can't figure out how to make money with moving averages or with Fibonacci ratios, then you don't know what you're doing. Well, my point is you don't need these tools. These tools probably don't actually help you to make money, and you don't need them. They're not adding anything. You just have another random input into your process. And even if you think I'm full of garbage here when I say this, it's an idea that I think at least deserves some attention and respect, and this is why I don't use them at all at my work. And again, we're kind of running up on the end of time here, but I will tell you that I think of market action as being shaped. We touched on mean reversion and momentum, and how do you actually trade these? Well, some tools that work for trading mean reversion: trading large single bars. So if you look for large volatility-adjusted measures, particularly in stocks tend to mean revert more strongly than some other instruments, fading 3-day, 5-day, 7-day runs, whatever number you want to use there. Fading breakouts of channel highs and lows. I just wrote a blog on this, looking at the difference between futures and stocks, but particularly in stocks, if you're buying stocks to make 50-day highs or 52-week highs, you're actually putting yourself on the wrong side of the market statistically. And there's very, very, very simple and convincing evidence that shows that. Yet, so many people talk about buying stocks to make 50-day highs. Fading large excursions from moving averages. We spent a little bit of time talking about Keltner's and Bollinger Bands. One thing that we do see with these, when you execute a system, when you execute a test, you have to have a precise number, of course. But we also discover that these things work with a very wide parameter set, with a very wide number of inputs, range of inputs. And maybe that should make us suspicious of precise values. That's also a good thing, right, because we want to see that the concept is robust. We want to see that, it's not my magical Bollinger with the 17-day moving average and the 2.93 standard deviation band. No, it's nothing like that. It's just the idea that we're trading large excursions from roughly average prices. You do need to be aware with this that different asset classes and time frames have different tendencies, so you can't just take a tool and slap it on any market. Momentum, good tools for trading momentum. Volatility compression. I suspect some of you asked questions earlier that probably drive to this, and what this is the idea that when a market becomes quiet relative to its long-term average. And there are a number of ways you can measure it. Some people do measure it with, you can look at the range of a Bollinger Band. You can look at the standard deviation of returns, would be a more quantitative measure. Historical volatility is ratios of different periods of historical volatility. But when a market becomes very quiet in the short term, then the force of momentum is likely to become stronger on any breakout. So what this does, and there are obviously direct implications for option strategies here, but if most large moves and stocks particularly fail, then after volatility compression, we see most large moves tend to continue at least for a predictable period of time. Pullbacks probably kind of the classic tool for trading momentum, and this obviously can be captured in chart patterns. I'm skipping over this. Let me see what I have here. I was going to do a little bit of discussion about counter trend and trend trading strategies, but I think I have far too many slides here. Some specific patterns that work, and one that works very well is this idea of a failure test, which is simply a market probes beyond a level and then comes back and fails beyond the level. It fails back inside the level, and this we see this over and over in markets, and this is a reliable pattern. When I say reliable, within the realm of probability, but this is a pattern that does have a significant edge. And then pullbacks, I think probably all of us know what pullbacks are. There's so many words for this. A lot of the labels that traditional technical analysis attaches to pullbacks, flags, box, wedges, pennants, that to me, those don't matter so much as the idea that we're looking for a trending market and we're looking to trade pauses in that trend. And of course, risk management can be a potential issue too. There's a lot more you can do with this, and I think all of this, you have to be quantitatively pointed in the right direction. But then there are many other pieces in terms of position sizing, risk management. In so many ways, the decisions you make once you are in a trade are significantly more important than how you get into that trade. Probably the biggest is where you get out initially. If you get into trade and it's wrong, where's your initial stop? And I think one of the mistakes a lot of people make is they use stops that are far, far too tight, and that significantly erodes whatever edge they might have had. And then a lot of this is really about developing the skills of successful trading, developing it's behavior. It's you doing the right thing. It's not you knowing what the right thing to do is. It's you actually executing. Want to touch a little bit on some current market conditions, and don't want to get too. Also, I will tell you, this is not a sales pitch, but if what I've said here somewhat resonates with you, I would love to have you take a look at my research if you have not already. Do publish a daily research note, an extensive weekend report. You can go to waverlyadvisors.com. It's advisors with an O, and there's sign up for a trial there. We give a free trial. Tell us that you found us through this presentation, and we'll give you an extended trial. And it's not a fit for every trader, certainly, but I'm very proud of the product, and I've spent a significant portion of my life developing this. So it's something that I think we've created something that works very, very well for many people, and I'd love to have you take a look at it. And that's all I'm going to say on the sales side. But if you are interested or might be interested, no obligation. In many ways, I think we're the opposite of a hard sales pitch. I have people who take the trial, and I end up telling them that I don't think it's a good fit for their situation. So, certainly no obligation, no pressure, but take a look at it if you'd like to. So if you have other questions, go ahead and type them in the box. I'm going to talk a little bit about how I take these concepts and apply them to what I'm seeing in both the S&P and crude oil right now, and then I'll spend some time answering your questions. I don't know how we're doing on time. I can stick around for probably 20, 25 minutes more, if that's okay with you guys.
Yeah, keep going, Adam. It's good stuff.
Okay, great. Thank you. So S&P 500, the biggest thing that I think has escaped everybody's attention, and by everybody I mean mostly the people making a lot of noise, biggest thing here is that we're in a bull market. We're in an uptrend. And if you look at this chart, which is a very, very long-term perspective. And by the way, I would encourage most people, if you use a long-term chart like this, you probably should be using a logarithmic scale. I did not. That was a mistake when I printed this chart out. But still, you see pretty clearly we are more or less straight up off of the 2009 lows. Now, I want you to think about a situation. Imagine the market is up 2 weeks in a row. We're up 2 weeks in a row. Then we go sideways for 2 or 3 days. Now, in that situation, would you ever hear people say, oh, this move's over, this is the end of the rally? Of course not. People would say, market's gone up 2 weeks, we're pausing for 2 or 3 days. No big deal, no big thing. Well, proportionally, that's what's happened here. We are more or less straight up off of 2009. And whatever you were thinking, I can hear some of you probably are thinking, well, quantitative easing, whatever. You have this list of reasons to explain why this move is wrong. Well, the reality is the market has rallied off the 2009 lows very, very strongly. And all we've done is pull back. It has been a year-and-a-half pullback. 2015 was a volatile, directionless pullback. The last part of 2014 was a turn into that. This year has been a test of the lower end of that range, but this is proportional, and people forget that. It is so easy to get caught up in the short-term fluctuations, and one of the things that I do in my writing and the research product is I speak to short-term traders, but I also speak to long-term traders, and the long-term trader needs to realize very clearly what type of heat might you have to take. If you're capturing a trend like this, then you have a 200, 300, 400 pullback, 400-point pullback in the S&P. It's no big deal. It's merely fluctuation within the acceptable range of this trend. So that's the context for this move. Now, if we zoom in, a lot of people talked about this trend line being broken, and this is the trend line. I'll go back to the monthly chart, but that's the trend line that's drawn off of this. I'm pretty sure it's the 2011 low up to this high. So we're not back down here, but this trend line comes off of here. And, of course, the angle is a little bit different because we're looking at a weekly chart. But this trend line was broken in the third quarter of 2015. We've been kind of fluctuating around. I don't think that is as important as, again, if you imagine we're in this very large range, let's call it 1,800 on the bottom, 2,100 on the top. We're in a large range, which, again, is consistent with the scope of the rally. One of the points that catches my attention, we talked about the failure test, which is the tendency of the market to test beyond a level and then to quickly reverse. And we can see that if we look at the number of these weekly candles that have these long lower shadows. Many more of those as opposed to candles that have long upper shadows. So this is one way that we see very, very simple price pattern, that we see buying pressure encapsulated in price movements. And that is potentially very bullish support for the market. And then we zoom in here on the daily chart, and you see, yes, this has not been an impressive start to this year. Is it significant that this is the worst start to a year for the stock market ever? I don't know if it is or not. I suspect it's probably not. But, you can take any point and say that this this is the worst February, worst March, whatever. It just happens to be the beginning of the year. And what we've had is a little bit of stabilization. Where did this retracement pull back to? Roughly 50%, give or take. No magical Fibonacci number. But we're starting to see more and more pressure against the upper end of this range here at 1950, and that is potentially strongly bullish. So, bottom line is I think we are still in a bull market. I think we're seeing more and more short-term bullish evidence pile up. There certainly is a probability of a failure around, let's just use round numbers, 1950. By the way, I also don't think, I've never seen any proof that there are any super significant magical levels in the market we need to watch. And I do have a YouTube video that shows that. It shows a pretty good example of that in vivid detail. But it's possible we could fail around this level, but the downside will most likely be limited until something significantly changes in the market. And frankly, I don't think what we've had here so far this year is a significant shift. So that's my current read on the S&P. Andrew asked if the monthly chart should be in log scale. Yes, it should have been, and I said that when we were back there. I may have mumbled when I said it, or maybe you didn't hear, but yeah, the longer-term charts, generally speaking, should be expressed in log scale. It puts everything in proper percentage proportion. So this is a look at the April 2016 crude oil contract. Now, most of us, when we see charts, we typically see back-adjusted futures charts. This is not. This is the April contract carried back a few years. And this gives us a healthy respect for the scope of the sell-off. And, there's not – sometimes we don't need to do deep chart. In general, I don't think we need to do deep chart analysis. I don't think there's any secret here. beyond the fact that we are in a volatile decline. We've had several pauses in that decline that have resolved very easily to the downside. Every time there's been a pause, we've resolved to the downside. Again, this is a 20-period moving average. These are Keltner channels. I don't think there's a lot of significance to any moving average. It does appear price stopped at the moving average, but that's kind of just random chance. Drilling down to a daily chart, bottom line here is there's no reason to look to buy this market. Everybody in the world is looking for some excuse to buy crude oil, some excuse to be the hero that caught the bottom of crude oil. I don't care about that. That's not my job. My job is to put on trades that are aligned with the probabilities in the market. Probabilities here are clearly aligned to the downside. I will miss the first move to the upside in crude oil, because that's where the probabilities shift. There was actually, if we go back to a good illustration here, this was September, I think. September. September of last year, crude had a good rally, and we saw a real shift in character here. And then we were setting up potential long trades, which failed. And that's, as you're looking to read price action around these patterns and resolution, that's typically the way it works. We have these setups, we have the patterns set up with potential, and then we have, then we see the patterns either succeed or fail, and that gives us some idea who the dominant force in the market is, and all of this is incorporated and encapsulated in quantitative pattern testing, but there's a good deal of subjective reading we can do here too. So that is, that's what I've had for today. Happy to take questions. I've got to go back and get the Python question, I know. If you have other questions, type them in. I'll tell you some places to find more information about me. I wrote a book a couple years ago, The Art and Science of Technical Analysis. You certainly can check that out. We have do I need to update this? Or that actually is your trading platform, isn't it? I'll just ignore that. And then you also do check out my blog, adamhgrimes.com. I do a podcast, which I've taken a brief break from, but it's because I'm concentrating on some other work. Only so many hours in the day to get everything done, but I am writing fairly extensively on the thank yous. Dennis says I have a nice blog. Do check out my blog. A lot of the things that I really glossed over today, I get annoyed when a presenter says, hey, I've done all this work, just trust me. That's an annoying message. Well, I didn't have hours to go through a lot of the work that I've done today, but it's on my blog. I have tests of moving averages. I have the Fibonacci stuff laid out in a lot more detail. I talk about the philosophy and the approach to looking at these patterns, and you certainly check it out there. And I love questions. Andrew also points out that I do have a free trading course. And the trading course is completely free. There's no upsell. There's no premium area. As you mentioned that, Andrew, the plugin that I was using is having an issue. So the trading course, I don't think you can access it tonight. Give me a couple days. There's a little bit of an issue with the trading course, but the material's all there. And sorry, I only have one brain. I can't think about too many things at the same time. The trading course encapsulates a lot of this quantitative work into a very practical, very applied framework. I'll teach you how to do your own back testing, how to do your own work. There's also some discussion of options, a lot of focus on risk management, a lot of focus on psychology. We have barely touched on that today, but the trading course certainly goes into that pretty extensively. So do check out my blog, adamhgrimes.com, and I think that is all that I had. So let me go back and read this Python question. So, okay. Specific training programs or websites get up to speed on Python. So I'll tell you my experience, and I was going to write a Python course and realized that I just can't do it for a number of reasons right now. What you will find, I think, there are a number of good resources to teach yourself the language. It's not a difficult programming language to learn at all. It is a little bit more difficult to figure out how to do the testing that you need to do and to figure out how to do the libraries. I guess what I'd like to do to really answer this question is Maybe I'll write a blog. Actually, I'll write a blog that will point you to some of these resources. I'm in the process of laying out a path to learning and developing these skills, and I'll talk a little bit more about specific resources and books you can check out. Because I found a couple books, and I don't know the titles offhand. I found so many bad resources, frankly, but I did find a few that are real gems, and I will share those on my blog. So check the blog and give me a couple days to write that, and I will answer that question a little bit better. I think that's it. Any other questions? Anything we need to do to wrap up here?
I don't think so. I just want to second Andrew's comment about the trading course. It's really good, and I highly recommend it for anybody who hasn't taken it yet.
Thank you very much.
And Adam, I really appreciate you taking the time to spend with us. And like you said, if people want to take a trial of your research, just mention that they saw this presentation at Capital Discussions, and I'll put a link on the replay for people to make it easy to get to. But again, really appreciate you coming, Adam.
I appreciate it, and again, I was a little bit difficult to schedule, and I apologize for that. But thank you for your patience, and I'm certainly happy I've got a chance to speak with you all today.
Thank you, Adam. We really appreciate it.
Thank you. Have a good evening. Take care.
Thanks, everyone. Bye.